Welcome to the weekly update, where I'll go over the action in the market for January 9th through the 13th, and then we'll see how things look for January 17th through the 20th. We had another positive week. A lot of our charts are really starting to improve, especially on the daily side, but we're getting a little bit short-term overbought, a little bit extended. We're running up into a downward trend line that may act as overhead resistance. But nonetheless, things are starting to look a little bit better. So let's go back and talk about the week. Stock market, it had decent gains during the week because it's still developing this idea that the Fed won't have to raise rates as long as they thought they would. Now, we have had no evidence whatsoever, really, from the Fed saying that this is going to happen. This is just a scenario that the market has been anticipating. And throughout 2022, it developed this scenario many times only to have it dashed. Well, we're starting to go through that process again now and possibly see what's called a soft landing, where the Fed can start to lower interest rates without basically without GDP going negative. On Tuesday, Fed Chair Powell did give a speech, but it really didn't have much of an impact on the markets. There wasn't anything necessarily new that he said. One quote is that restoring price stability when inflation is high can require measures that are not popular in the short term as we raise rates to slow the economy. Pretty much what the Fed has been doing, and nothing new there. The S&P for the week was able to, first of all, get back above its 50-day moving average. And then on Thursday and Friday, we were able to get back above the 200-day moving averages, and we're just a little bit below 4,000. We're at 3,999 right now. On Thursday, this was the big report. The CPI came out, and it was pretty much in line with what the market had expected. Inflation is still high, but it's starting to come down. It had been at 7.1%. Well, it declined down to 6.5%. If you take out food and energy, that's the core CPI, it fell to 5.7%, where it had been at 6%. So again, it's still high, but it's starting to come down. One area where there's still a lot of inflation is the services area. This didn't improve, and it rose to 7.5% from 7.2%. So that's just another area that is a little bit of a concern for the markets. Also, they've developed this view that they'll pause their rates sooner rather than later. Again, we don't know what's going to happen. The market has tried to front run the Fed several times in the last year and has been unsuccessful each time. The one thing that was a little bit encouraging when Fed Chair Powell spoke on Tuesday, he knows what these scenarios are. He reads what's going on. He has to, or else he shouldn't be the Fed chair. And he didn't come out and necessarily dispel that, kind of like what he did at Jackson Hole last spring, when the markets just really got caught off guard and thought that he was going to issue a pivot at that point. That didn't happen, and then we really tanked after that. Well, at least on Tuesday, he didn't do anything that really caused the market to go down. There was a big move that was leading up to the CPI. And as I was putting out the daily videos, I thought, is this a buy the rumor, sell the news kind of a thing? Turns out that was not the case. We ran up going into the CPI report. We didn't see a sell-off after it was released. That can be seen as positive. Then on Friday, there was a pretty weak open. We gapped lower, but then we spent the rest of the day clawing back, and we ended up having a pretty strong close compared to where we opened. Not from Thursday to Friday, but from the open to the close. Really showed some improvement. Interest rates ended up declining this past week, where the dollar is also falling. It's down into the 102 range currently. And oil is starting to go back up. It's just under 80 at 79.86. So we ended up being up 2.67% on the week. It was a pretty positive week overall, but volume is still below average overall. And the technicals are looking a little bit better. I'll go through some of the charts. And the big focus right now is really the earnings per share. That gets into the inflation interest rate growth scenario, both domestic and foreign. And I have a number of charts to go through to talk about that. Our trend is still on the weekly chart. It's weakening and it is negative. The red line is still on top, but it's starting to come down. We've switched over positive in the daily chart, but we're still below 20, but the ADX is starting to turn back up. So it could be the beginning of a positive trend. Here is the week showing you each one of these bars is 10 minutes, where we opened up a little bit higher on Monday, had a pretty good day, but then really started to decline going into the close. Tuesday was pretty much flat. We gapped higher and closed higher on Wednesday. This is when the CPI came out. So we saw a lot of gyration right after the market opened, but it seemed to like what was happening. So it held on to a lot of the gains. It closed off of its high, but it didn't decline. And then this is Friday, where we gapped lower and then spent the rest of the day clawing our way back. So for the week, the Dow was up 2%. The NASDAQ was up 4.8%. The S&P up 2.7%. They rounded that up. And the Russell 2000, the small caps were up 5.3%. So it's a pretty solid week. Here is from Monday to Friday how the different indexes performed, with the small caps doing the best. The NASDAQ and NASDAQ 100 had good solid gains. Then the mid caps, the pink one here, that's the S&P 500, and the NYSE, which is a broad measure that we look at, as well as the Dow. Everything was up, but we saw the most strength in small caps and in the NASDAQ. This is going back to the beginning of the year, where so far the small caps have been performing the best, followed by the mid caps, NASDAQ, NASDAQ 100, and everything is up to this point. So it is showing some improvement, but there's still a lot of damage that needs to be repaired. This is looking back all the way to the all-time high set in early January of 2022. This just shows how the different indexes have declined, where, okay, this past week, the NASDAQ and NASDAQ 100 had good weeks, but look at how far down they still are from the all-time high. Looking at our different sectors, this is for the week showing that consumer discretionary, that ended up performing the best, which really got hammered a lot in 2022. And this is showing some signs of improvement. This is a little bit more into the growth area of the stock market. Tech, which had a really difficult 2022, also was up 4.62%. Real estate, which has been seeing some weakness lately, it was up. Materials. And then there were two sectors that were down, healthcare and staples, which, especially staples, this tends to be more defensive. This holds up better when the market is declining, where discretionary tends to suffer. Well, we just saw the opposite of that in this past week. This is just looking at the past week with how all the different sectors performed in a more graphic way. Discretionary did the best, with staples and utilities actually being down on the week. And then this goes back to the all-time high, where energy is still the best performing sector, followed by utilities, and then all of the other sectors are still underwater. The current market valuation, at the time I record this, I've been waiting and waiting and waiting. I think because it's a 3-day weekend, they didn't update those charts. So I'm just going to quickly go through these without saying anything, because these have not been updated since the last video, but I wanted to get this recorded and posted. As of Friday, sentiment was at 63, so we're leaning more into the positive area. And here is the chart just showing how we've been improving as far as sentiment. So people are feeling a little bit better, but not necessarily extreme positive at this point. This is the asset managers survey that comes out every week, and we're seeing some improvement there. It started to get really bad back in October of 2022, and it bounced up, fell back, but it is showing some improvement, giving us a reading of 45.31. We're kind of getting up more towards the neutral area. When we get closer to 60, that's about neutral. And then when we start to get up into the 80 to 100 range, that's when they're getting extreme positive. Just like the 40 to 20 and even below 20, that's the extreme negative range. Also, the latest reading of the RightX bear bull ratio, more people are still getting into the bearish funds, thinking the market's going to go down, but it has been decreasing lately. And again, these folks tend to react more. If we have a down day, they jump into the bearish funds. If we have an up day, they jump into the bullish funds. And especially when we've been bouncing around a lot, they're just doing the exact wrong thing at the exact wrong time. And it's really hard to keep up with what's going on there. But it has been decreasing, but still we're really leaning more towards the bearish side, the negative side of the mutual funds. We had the individual investor weekly survey come out where it had been extreme negative, showed a little bit of improvement in the latest reading. And then this is that same chart, only it has the S&P 500 over top. And these are a lot of things that I've talked about at different times. You may want to pause this and just look at this, but this is where the market has been going down since the Fed started having rate hikes. And you can see sentiment really followed that. This is the Fed taper tantrum because it doesn't really like what's happening right now. And that then back at Jackson Hole, Powell says no pivot, and the different events that have happened. So you may find this useful to stop and look at. We also on Friday had the initial or preliminary consumer sentiment reading. It has improved. It's up to 64.6. It's still very low, and there's still a pretty wide spread between the 2-year yield and how people are feeling about things, where these tend to be closer together and they tend to go in the same direction. They're still pretty much going in the opposite direction currently. As far as the economy, I have a number of Isabel Net charts to show you. This is a survey showing they're looking at professional forecasters. I'm not really sure what that means. I mean, if you have a podcast or something and somebody pays you $5, are you a professional? And you say, we're going into a recession. Well, those that are suggesting that we're going to go into a recession in the fourth quarter has really spiked up right now. And where we've been down around this midpoint range, well, you kind of have a more of a consensus that this may be what happens. Looking at the economy, the spread between the risky loans and the not as risky loans, it's still not spiking up. It's still declining a little bit. So that still suggests that things are under control as far as that is concerned. And then looking at the National Conditions Index, we're still below this black line. We only really get concerned about that if we go above the black line. So this is showing that things are still under control there as well. Also looking at the performance of the cyclicals. These are the things that go up and down with the economy against the defensive. These would be the staples, the things that you have to have no matter what's going on. And then putting the ISM Manufacturing Index, which is a very important economic measure, on top of that, where this just shows that really they've both been declining. So we keep up with this pretty closely. So it's not a real surprise that as we're seeing a downtrend with the ISM manufacturing, we're also seeing that the cyclicals are really underperforming the defensive stocks. This would be the value is outperforming the growth. That's another kind of loosely way of combining them. This is the Atlanta Fed GDP now reading of where do they think GDP is going to be. And this is the estimate, this green line and how it's dashed all over. They think we're going to be anywhere from 3 to 4%. But if you talk to the different economists, right in about the middle, you have your top 10 economists and your bottom 10. They're anywhere from a little over 2% to actually slightly negative for GDP. This is what it looks like more graphically, where this is what we're starting to discuss now is the fourth quarter of 2022. Is that going to be positive? Is this the forecast that is actually going to come out when they release the numbers for that? Then also looking at the ISM services, we're seeing a real drop in that, and it's dropped below 50. This suggests that there's a contraction. So this is also suggesting there's more of an economic slowdown. Then we have also the services price series and how it tends to lead the CPI. So this blue line has been going down. We've shifted forward the CPI right here, and that just suggests that inflation should still start to go down. Then the non-PMI leading earnings indicator, this is put out by Morgan Stanley, just shows a decline as well. And then there's the slumdog billionaire. This is back when the market hit its high, the big tech, it made up 30% of the S&P 500's market cap. As of the time that this chart was created, it's dropped down to 21%. So that's a lot of value that's been taken out of the market. Then this is the leading economic indicator. And I don't really pay attention to this as much when it's released, but I do like to look at this over a period of time. This is looking out into the future, and we can see that it is showing that there is a decline. They're not really seeing some positive things into the future, and that could have some real impact on the stock market. Looking at some of our charts, even though we've been going sideways and we had some significant down days, the VIX really hasn't been acting all that normal these days. With the up week that we just saw in the last few days that have been up, the VIX has actually dropped below 20. That just shows that we're possibly getting more into a complacent period. And this could be shifting down, where before we were more up in the range kind of between 20 and 40 or so. We could shift and then go down here where we were down below 20 for a period of time. There are the static number ways of looking at this, the 20 line, and then we go down to 12 down here. But to be a little bit more dynamic, you might shift this. You can see where the VIX itself goes through different periods of time. And I haven't been showing this chart all that much just because it's really been declining. We're watching other versions of the VIX chart currently. And the ulcer index is just showing that we're dropping. That means fear is really decreasing and we're starting to turn more positive. Looking at earnings and valuation, this just shows times when we're above this line that we're getting expensive, and they're calling it the everything bubble, where we were just going up and up and up after the whole COVID lockdown, the COVID crash, and then the bounce up out of that. Well, now we are starting to decline. And then this earnings, this is a big deal of why stock prices go up and down. This is the earnings breadth and the revisions that are being taken versus what's going on with the S&P. You can see that they are both declining because it's ultimately earnings what drives stock prices. Then this says this would put the S&P earnings per share closer to long-run trend or normalized levels. Even though we've been coming down, we're starting to come down if you look back for a long, long period of time, we're coming back down to more normal levels. Then the price to sales ratio, it has fallen, but it's still relatively high. It's coming down, but if you look at it overall, it's still giving us a pretty high reading. Then this is the Shiller PE ratio, which is suggesting that stocks are still expensive. It's giving us a reading of 29.24, where the median and the mean is between about 16 and 17. So on a historical basis, stocks are still considered expensive, but they've been showing us that for quite a while. These are earnings surprises. When a company comes out with their earnings, do they surprise to the upside or do they surprise to the downside? Well, it's really been tapering off with those surprises that are more positive because we're seeing a real contraction of the earnings per share and the growth in a lot of companies. So it's dropped below the median at 5.1%. Then the ISM, it also shows that this earnings per share has already been priced in right now. The thing that I'm really looking at on this chart is that the new orders are declining and the earnings per share of the S&P, they are also both declining. And then we get to the fact set, and there's a couple of blog posts where earlier in the week it was posted, are more S&P 500 companies issuing negative earnings per share guidance than the average? Well, if you look at it down here, the number of companies, it's above the 5-year average, but it's equal to the 10-year average. And then you look at the chart down below, and this just shows how more companies are tending to lower their earnings per share forecast and their guidance. Another article with a couple of charts, this says, will the S&P actually report a decline in the earnings in the fourth quarter? As of today, it's expected that it will be down 3.9%. And here's the chart showing how earnings versus actual earnings have been declining. This is similar to the chart I just showed you about the surprise earnings, where they have also been declining. And that's why you see stocks under pressure. As far as inflation, we had CPI this week. The orange line here, which is a combination of the yellow and the red, that's the number that we were given. It was at 6.5%. Well, if you go back to how it was calculated in 1990, we would be at about 10%. And if you go back to how it was calculated in 1980, we would be just under 15% for inflation. but they're really starting to project that core inflation, they're forecasting that is going to continue to drop. The goal of the Fed is to try to get back down to this 2% level. And then this compares the consumer price index, and then it takes those sticky items. These are things that where the prices don't change all that much. Well, that's the red line, and that is really starting to go up. The blue line, this is flexible. These things that they go really all over the place as far as their prices. That is starting to come down, but we're seeing those things that don't change their prices much, that has been advancing. As far as the Fed, after Friday's session, there's a 93.7% chance that we will be at 4.5 to 4 3/4 at the next meeting on February 1st. Right now, we are at 4.25 to 4.5. So that means that there's a 93.7% chance that the Fed is going to raise rates another 0.25% at the next meeting. But this changes all the time. And with other economic reports that come out, this can really deviate from what we're seeing right now. Then this is the Fed balance sheet, just showing how, as they said, about midway through 2022, they're starting to lower the balance sheet, getting rid of assets that were purchased during the whole COVID lockdown and all the stimulus and quantitative easing. And this is quantitative tapering, whatever negative thing you want to call it. This is having a real tendency to put a lot of pressure on the markets. This is just another one that you may want to pause and look at. This is also the balance sheet. And as it's been rolling over, these are just different events that have happened to give you some historical context. I could spend an hour going through all of this, but the big thing that we need to watch is as the Fed's balance sheet is going down, that's also been putting pressure on stocks. Looking at breadth, where we had a pretty good week here, we showed some real advance based on price, and we're showing some improvement based on volume. And then the advanced decline ratio is also improving. It's going a bit higher and it's above 0. New highs, new lows are also improving with our 4-period simple moving average, and our 10-period moving average is also turning up. Accumulation distribution also showing some improvement. As far as our trend, this is what I'm talking about with the ADX declining, and we're getting just a little bit under 20. It's almost in a trendless environment. It looks like the green line might, if we see more follow through buying, the green line might be able to cross above the red line, but we're getting more into a trendless situation. And we're that way with the daily charts, but it could be turning into a trend if we see more follow through buying. And then it would just stand to reason that if the daily charts turn into a positive trend, eventually the weekly charts will follow that as well. This is the Arun indicator, really no change here. The red lines measure selling, the green lines measure buying, and although they both have been decreasing, the comparison between the two is really not changing. The mass index, we're not getting a signal from this now. We only pay attention to this when it gets up around the dashed red line and then to the blue line, but it's going in the opposite direction now. Some of our longer term charts, well, first of all, we look at a daily chart. This is the long-term trend line that I've been talking about. And we've bumped up into this area numerous times now. We're getting a little bit overextended on a daily basis, so we may not have enough power to break us through right now, but can the market muster up enough energy to eventually, we're back above the 200-day moving average. Can we break above this trend line and then end up closing above it and then stay above it? And then with our weekly charts, can we get a close above this level as well? But we have some pretty hefty overhead resistance. The trend line itself, then we have R1, and then we have this longer term resistance level, and the market's going to have to battle to get through all of those levels if it's even able to do that. This is pretty much showing the same chart, just with some different annotation. This is the downward line here. We're still above the 200-week moving average, and we're just bumping up into resistance now. And are we going to be able to break through that, or is the market going to turn and go back down like it has before? This is the overbought, oversold composite. This just shows the black line is the S&P itself. And right now we're giving a score of 56. So we're kind of midpoint currently as a technical score. Then the trend channel, we're starting to come back up. We got a little bit below the midpoint of the trend channel. We're starting to come back up a little bit from there. The pivot points were just underneath the pivot point now for January. If we can get above that, that would be above the 4,000 level, and that would turn things a little bit more positive. And then we're coming back up to the 50-period simple moving average, which that's 50 weeks. So this would be roughly 1 year. We have already crossed above the 200-day moving average, but we have not gone above the 50-week moving average yet. The long-term trend is still negative, but showing some improvement. And the bullish percent index is above 50 and advancing. And we're seeing pretty much the same thing on the daily chart. So this is more of confirmation that things are moving more together. Chaikin oscillator is above the midpoint and advancing. So that is positive. Chaikin money flow also with a green bar does show that we are improving. The force index is also above 0 in green. So there's some improvement there. McClellan oscillator starting to look a little bit toppy, but it could go even higher than this. But that is positive overall. And our summation index based on price is advancing as well as volume. And they're both above 0. So that's really improving the technical picture. These are the weekly charts of all of our different oscillators where you have this, you have the slope and the TSI. This is just trying to cross positive where the slope already has. The MACD is turning over, the PMO and the PPO is trying to roll over. Our longer term oscillators with the tricks and the KST are looking more positive as well. The daily charts show all of our oscillators are going up. This is a little bit of a mixed picture here, but this is also confirming that for the most part. Swell trading oscillator advancing based on price and volume and starting to almost get a little extreme based on volume. The PMO, this is one of the oscillators that we looked at. It's turning up and advancing above 0 based on price and volume. The PMOs that are rising, starting to get a little extreme positive, but this could still go higher. We're still headed up with the buy signals, and we're still advancing with those PMOs above 0. The RSI has crossed back above 50, and it's not giving us an extreme reading right now, so that's more positive. The special K, even though it's still declining, it's still above this moving average, so that remains positive. The Stochh RSI starting to get a little extreme positive, and the Williams percent are just barely into extreme positive territory. The Vortex has the green line on top and the red line underneath, so that's looking more positive. Ultimate oscillator above the midpoint and advancing, so that's more positive. Money flow indicator, it's actually turned down a little bit, but we're still above 50. Bollinger Bands, this is above the midpoint and going up, so that is more positive. Going back 1 week, the rate of change just shows that we advanced and not necessarily extreme right now. Going back 50 weeks after giving us a pretty extreme negative reading is showing some improvement. The Copic curve, we have a buy signal that we're working off of on the daily charts. Well, we have a buy signal here on the weekly charts as well. Here is a weekly chart showing that we might be getting ready to see a golden cross. This is the 10-week and the 40-week, and we were able to close above that. We're above this Fibonacci retracement level at 38.2% at the 3812 level, and we're well above the 200-week moving average. We came down last fall, tested this, fell down below it, but then we're able to bounce back above that, and we've been showing some improvement so far into 2023. Our different charts, the Heiken Ashi looking more positive with an open candle. The Kegi is black and advancing. That's more positive. The Renko has an open box. That's positive. The ease of movement, looking back 1 week, is positive, and going back 14 weeks is also positive. Saw some new X's drawn on the point and figure chart. It's not generating a signal, but this is looking much better than it had been. The 3-line break, still looking more negative with black colored down bars. The Elder Impulse system switched back to a green bar, which is positive, but we're still underneath this 65-period exponential moving average. But the fact that it turned back green is also positive. The SAR, it still has the dots underneath, so that is positive. Looking at the broad market, here's the S&P, here's the mid caps and the small caps. Not really seeing a lot of divergence or convergence right now. They're having a more tendency to go in the same direction. It's the small caps and the mid caps that are looking more positive. They've been turning up, and that could be positive for the market overall. Where all stocks starting to cross back above these moving averages, we're seeing the blue moving average turn back up, but it hasn't crossed yet. But this is showing a lot of improvement. And then valuations, they still remain vulnerable to rising yields, where here you have the forward-looking PE ratio. That's the dark blue, and it's been declining. And then the light blue line here is the 10-year yield, which is inverted because these have a tendency to go in opposite directions. So if interest rates really start to go back up, that could really put a lot of pressure on the stock market because it could really hurt the forward-looking PE ratio. The mid caps starting to show some improvement, looking better on the daily chart and possibly getting ready for a cross on the weekly chart. Small caps, not really near a cross yet, but showing some improvement. And then it says here that the small caps, they're cheap, but they're still exposed. You look at here on the top, it shows that they're really undervalued here, but the macro environment is a headwind for small caps. So half full, half empty. Well, we just kind of have to take it day by day where they're undervalued. But at the same time, in this kind of an environment, it's really difficult for small companies to grow. Then the Dow is looking more positive and has been holding up a lot better. And we're just starting to see a golden cross on the weekly chart. The NASDAQ still has a ways to go, but it had a good week. And here's the NASDAQ 100, also a ways to go, but looking potentially better. The Wilshire also showing some improvement, but still negative. The NYSE looking much better, breaking above the moving averages, but still have not seen a cross yet. The FANG stocks, this is Facebook, Amazon, Netflix, Apple, Google. These are the real big companies. They still are in an overall downtrend, even though they were up over 8.5% on the week. ARK was up 14.73% on the week, but still is in a pretty hefty overall downtrend. And then the biggest software companies still continue to be in an overall downtrend. And here's Dow theory, where we just look at Dow, the transports, and utilities. Not really seeing anything out of line necessarily. I add utilities to Dow theory, where the main thing is to look at, are the Dow and the transports, are they behaving more in tandem with each other? CRB index starting to see a decline now after seeing a death cross recently. Copper, which has really bounced up in the past week, it's still in an uptrend. It had been showing some weakness, but we're going to keep an eye on this because this tends to go higher when they look out into the economy and they see a brighter future. This tends to really fall when that future isn't as bright. Gold on the daily chart, it's just starting to give us a golden cross. It's been really rebounding nicely, mainly because the dollar has been going down, but we're not seeing a golden cross yet on the weekly chart. Silver, we did see a golden cross here, and so it is starting to improve. Oil is down around just underneath the $80 level. Here's a weekly chart of the dollar after just really screaming up higher, has really been declining, and on the weekly chart is now starting to show a downtrend. Looking at interest rates, bonds are also showing some improvement, but we could be hitting some resistance at this downward moving average, and we have not crossed over yet, but things are looking a little better. This is the MOVE index, which is like the VIX for bonds. It shows where volatility is still pretty high, but not as high as it has been. This is the market implied terminal Fed funds rate. This is when they think that the Fed is going to top out. Right now, it's between about 4.91%, where you hear in the media, they're talking at about the 5% level. And then this is the consensus in rate hikes. That'll be 50 basis points in the first half of 2023, and then they'll do cuts after that. So this is just a forecast where they're going to raise rates all the way up to 4.9% as of spring in 2023. And then after that, they will start to decline. It'll be down at around 3% in a year from now, basically in December of, 2 years from now. Okay, and then here's a daily chart of the interest rates and how they've been bouncing all over the place, kind of having a tendency to go more down, but we still have a lot of inverted yield curves. Here's a weekly chart showing how the US, UK, and German rates have been rising, but lately have been coming back down. And then Japan's kind of in its own situation where their rates are now starting to go up. Some relative studies. Here's the intermarket analysis. This is going back to the beginning of 2022, showing how oil has been doing the best, followed by the dollar. Gold has finally turned positive, where you still have stocks and bonds negative. And this is the bond to stock ratio. It shows that it's still underperforming. And here's the stock to bond ratio, showing how stocks have been outperforming on a monthly basis, even though we are seeing some recent weakness. Gold to the US dollar. When the dollar was really going up, this ratio was going down. Well, now gold's going up as the dollar is going down. So we're seeing a lot of improvement in this ratio. Gold to the S&P, even though the S&P has been doing well, gold's been doing even better. So it is outperforming the S&P. And the low volatility stocks, even though they're showing some recent weakness, continue to be in an overall uptrend. And then growth to value shows how growth has been underperforming value. Then this is the underperformance of value to growth. It has shifted. Basically, we spent a long period of time with growth really leading the way. Well, then we've been coming down, and now that is really starting to shift. And that's why we're seeing this value versus growth starting to win out. Then the NASDAQ 100 against the S&P, still showing that the NASDAQ 100 is underperforming, even though it bounced up a little bit this past week. The S&P 100 has been underperforming the S&P 500, and discretionary have been underperforming staples, and energy has been outperforming the tech sector still. So what's our outlook then? This is based on the upcoming week, where we're closed on Monday, but on Tuesday we have the Empire State Manufacturing. Wednesday will be the MBA Mortgage Applications Index, and PPI. That'll be a big one, and retail sales is a big one. Wednesday's like the day here. Industrial production and capacity utilization will be coming out, business inventories, and then the NAHB Housing Market Index. Getting a ton of data on Wednesday. On Thursday, we'll have housing starts and building permits. That can look into the future a bit and give us an eye view of what's happening in the housing market. And we'll get the weekly jobless claims, the Philadelphia Fed Index, which is more regional. And then on Friday, we'll get existing home sales. So our technicals, you can see that they're improving, and we're seeing the potential of things starting to get better, but we need to see more follow through on the daily charts and then have that feed over into the weekly charts. Inflation and interest rates are really where it's at, but we still have that whole list of things that could come in and impact the market at any time, and then any kind of Fed speak that may come out. Then another thing that I've been doing in the daily videos is I have the Stock Traders Almanac, and I'm going through that each day, and I'll go through that in the weekly video as well. I'm going to go through that kind of quickly, because go back and watch some of the daily videos. I don't want to have this video get to be too long. But looking at the period from January 2001 up to December 2021, looking at January 17th, which will be Tuesday, the Dow has been up 52.4% of the time. So has the S&P 500, but the Nasdaq's been up only 38.1% of the time. So this is not really telling us anything. It's probably more of a negative slant for Tuesday. They just look at all the January 17th and they compare them, and this is the score that they're giving. If you look at all the Januaries going back to the year 2000, 10 of those have been up, where 13 of those have been down, so more have declined than have advanced. For the quarter, even though this isn't a quarterly measure, the 3 months out of the year, November, December, and January, tend to be the best 3-month span of the year. And then yearly, we're looking at the January barometer, which we won't get this until the end of January, that since 1950, the market has followed the January barometer. If it's up, 83% of the time, the market is up too. If it's down, then 83% of the time, the market has gone down. So this is called a trifecta, where we had the Santa Claus rally, which that ended up being up, as much as it probably didn't feel like it. That gave us a score of 1. Then the first 5 trading days of the year, they were up, so that gave us a score of 2. And then we're waiting for the third score to see what will happen. So when all 3 indicators were positive, the next 11 months, they were up 87.1% of the time, giving us average gains of 12.3%. And if you look at the full 12 months, it was up 90.3% of the time with average gains of 17.5%. So the market, it's also like having a mixed government, basically split between Republican and Democrat, and that's what we have currently. This is another chart just kind of showing you the same basic things. They've kind of flipped this around, but this gives a lot of the same basic stats for the Stock Traders Almanac. See here where we still have a question mark. We don't know what's going to happen yet until the end of January. So our scenarios can't really go with the down scenario right now because things are looking a lot more positive. We could kind of go with the upward scenario, but we're not trending on the daily charts yet. And looks like we're going into a sideways look on the weekly charts, even though we're showing a lot of improvement right now. But we have overhead resistance where we're at currently. So we're still going with this sideways trend, even though the ADX is strengthening, but it is below 20 and the green line is on top. So it's more positive. Thank you. Have a wonderful week. I hope you had a great 3-day weekend. I've also posted other videos as well for you to view. So I just hope you have a great success this week, and I'll talk to you in the next video.